In Sweden, we have an old saying that every child learns before they are allowed to play outside in the snow. There is no such thing as bad weather, only bad clothing. It is a simple lesson, but it carries a profound truth about how we survive and how we thrive. When the temperature drops and the wind begins to howl, you do not blame the sky. You simply put on a heavier coat. You prepare. Right now, if you look closely at the global economy, you can feel a shift in the wind. The long, warm summer of easy money is fading. The days of endless liquidity, where every risky investment seemed to go up simply because the sun was shining, are behind us. We are entering a different season. You might call it a correction, a recession, or a downturn. I prefer to think of it as an economic winter. Winter is not something to fear. It is a natural part of the cycle. It clears away the excess growth of the summer. It tests the strength of the forest. But here is the problem for most investors today. They are standing in the falling snow, wearing nothing but summer clothes. They are holding assets that rely on sunshine and optimism. They are holding speculative technology stocks that have never seen a recession. They are holding cryptocurrencies that promise warmth but offer no shelter. They are exposed. And when the real cold sets in, when the markets freeze and the panic spreads, they will realize too late that they have no heat source. This is why we are here today. We are not going to talk about how to predict the storm. We are going to talk about how to stay warm regardless of how cold it gets. We're going to talk about firewood. In the world of investing, there is a specific type of asset that acts exactly like dry, seasoned firewood. It is not flashy. It does not grow to the sky like a beanstalk. It sits quietly in the corner. It is boring. But when you need it, when the power goes out and the heater fails, this firewood is the only thing that guarantees you warmth. This asset is the short-term United States Treasury Bill. While the rest of the financial world is frantically trying to guess which way the wind will blow, the wealthy are quietly stacking this firewood. They are locking in guaranteed returns. They are securing their cash flow. They are preparing to sleep soundly through the long night, while others stay awake worrying about their portfolios. In this video, I'm going to show you exactly why this humble instrument is the ultimate recession-proof tool. I will explain why chasing high returns right now is a dangerous game and how you can build a fortress of stability that pays you month after month without fail. If you are looking for excitement, hype, or promises of overnight riches, this is not the place for you. But if you are looking for shelter, for clarity, and for the peace of mind that comes from true preparation, then you are in the right place. Welcome to Mindset for Wealth. Let us begin building your fire.
Welcome to Mindset for Wealth, where money meets mindset.
In the West, particularly in the fast-paced markets of New York, the goal is almost always maximization. How do we get the most? How do we grow the fastest? How do we squeeze every last drop of profit from the stone? It is a mindset of abundance, born from long summers of economic growth. But in the North, we think differently. We do not optimize for the highest possible peak. We optimize for survival. We understand that the tallest tree is the first to snap in the storm. This brings us to the philosophy of essentialism in investing. When the economic climate turns cold, the rules of the game change. During a boom, you can afford to take risks. You can plant seeds in rocky soil and hope they grow. But in a recession, your priority shifts from expansion to preservation. Many investors today are making a critical mistake. They are still hunting for summer fruits in the middle of winter. They are looking for 10% or 20% returns in a market that is trying to contract. It is like wandering into a snow-covered forest looking for strawberries. Not only will you fail to find them, but you will freeze to death while trying. We need to redefine what safety actually means. Ask an average investor what a safe asset is, and they might point to a blue-chip stock or a piece of real estate. They call it safe because they believe the price will not go down to zero. But in a liquidity crisis, price stability is an illusion. Real estate can sit on the market for months without a buyer. Stocks can lose 30% of their value in a week if panic sets in. True safety is not about the price on the screen. True safety is income certainty. It is the absolute knowledge that on a specific day, a specific amount of money will appear in your account, D, regardless of what the news says, regardless of who is president, and regardless of whether the stock market is red or green. This is where the difference between wet wood and dry wood becomes clear. Imagine your portfolio is a wood pile. Stocks, real estate, and corporate bonds are like wet wood. They have potential energy. They might burn eventually if the conditions are perfect. But when it is raining and cold, wet wood just smokes. It hisses. It requires constant effort to keep it lit. In a recession, dividends get cut. Tenants stop paying rent. Corporate earnings miss their targets. The heat you expected simply isn't there. Treasury bills are kiln-dried oak. They are pure, stored energy. There is no moisture in them. There is no uncertainty. When you place them in the fire, they burn. They provide heat immediately. They do not depend on market sentiment or consumer confidence. They depend only on the mathematical certainty of the contract. To survive the winter, you do not need a forest of wet wood that looks impressive but provides no heat. You need a compact, protected stack of dry wood that you can rely on. This is the essence of the Nordic approach. Strip away the complexity, strip away the hope, and keep only what works. Let us step closer to the fire and examine this fuel. What exactly is a treasury bill, and why is it the bedrock of the entire global financial system? To understand this, you must understand the concept of the risk-free rate. In every economy, there is a baseline. It is the floor beneath your feet. It represents the return you should get on your money if you take absolutely zero risk. If you buy a stock, you are taking a risk, so you expect a return higher than this floor. If you buy a corporate bond, you are taking a risk that the company might go bankrupt, so you demand a premium. But the treasury bill is the floor itself. It is the purest form of collateral in the world. When you buy a treasury bill, or T-bill for short, you are lending money directly to the United States government for a very short period of time. Usually, this ranges from 4 weeks to 52 weeks. You are not investing in a company that needs to sell products to survive. You are funding the government. The way it works is beautifully simple. There are no monthly interest checks to deposit. There are no complicated calculations to track. Instead, you buy the bill at a discount. Imagine you want to buy a bill with a face value of $1,000. You do not pay $1,000 for it. You might pay, for example, $990 today. You hold that bill for 4 weeks. At the end of those 4 weeks, the government gives you back exactly $1,000. The difference between what you paid and what you received is your profit. It is clean. It is precise. But you might ask, what if the government cannot pay me back? This is where the term full faith and credit comes into play. These bills are backed by the taxing power and the economic engine of the United States. While no investment is theoretically impossible to fail, this is as close to gravity as finance gets. If a day comes when the United States Treasury cannot honor a 4-week bill, then the dollars in your pocket, the stocks in your portfolio, and the balance in your bank account will likely be worthless anyway. In that scenario, nothing financial matters. Therefore, as long as the financial system exists, this bill will be paid. Now, why do we focus specifically on short-term bills? Why not buy a 10-year bond? This brings us back to the concept of dry firewood versus timber. A 10-year bond is like a giant tree trunk. It contains a lot of wood, but it is heavy and difficult to move. If interest rates rise, the value of that long-term bond falls. You get locked in. You are trapping your money in a contract that lasts a decade. A short-term T-bill is like kindling or small logs. It burns quickly and releases its energy. Because the duration is so short, perhaps only 1 month or 3 months, you are never trapped. Your money comes back to you constantly. You are liquid. You are agile. In a recession, liquidity is power. You do not want your wealth locked away in a 10-year contract. You want it maturing every few weeks, ready to be deployed, ready to cover an emergency, or ready to be reinvested at a higher rate if the winter gets colder. This is the mechanical advantage of the strategy. It keeps your options open while keeping your capital safe. It is a common instinct to seek shelter in the most familiar place. For most people, that place is the bank. You see advertisements for high-yield savings accounts promising you attractive returns, perhaps 4 or 5%. It feels safe. It feels easy. You deposit your money and you see the numbers grow. But there is a flaw in this design. When you rely on a savings account, you are not actually holding the firewood. You are handing your wood to a neighbor, who then rents it out to someone else, takes a cut of the profit, and gives you what is left. Think about how a bank works. When you deposit your money, the bank does not just lock it in a vault. They take your money and invest it. Often, they take your money and buy the exact same treasury bills we just discussed. If the government pays the bank 5%, the bank might pay you 4.5%. They keep the difference. That is their business model. They are the middleman standing between you and the source of the heat. Why would you pay a middleman when you can go directly to the source? But the fee the bank keeps is not the biggest leak in your bucket. The real enemy of your wealth during a recession is invisible to most people until tax season arrives. That enemy is state income tax. If you live in a place with high taxes, like California, New York, or even Minnesota, the interest you earn from a bank account is fully taxable. The state takes a bite out of every dollar of interest you earn. It is like gathering wood all summer, only to have the taxman come and take 10% of your pile right before winter starts. This is where the Treasury bill reveals its hidden strength. The interest you earn from the United States government is exempt from state and local income taxes. Let us do the math in our heads. Imagine you have a bank account paying you 5% and a Treasury bill also paying you 5%. On the surface, they look identical. But if you live in a state with a high income tax rate, that bank account might effectively only be paying you nearly 4% after the state takes its share. The Treasury bill keeps the full 5% in your pocket. Over a month, this might seem small. Over 10 years, it is a fortune. It is the difference between a house that is fully insulated and a house with a window left open. Both have heaters, but one retains the warmth while the other bleeds it out into the cold air. Furthermore, we must talk about control. When you put money in a bank, you are legally an unsecured creditor. You are lending money to a private corporation. Yes, there is insurance, but banks can fail. Banks can freeze. We saw this in the spring of 2023. It was chaotic. It was stressful. When you own a treasury bill, you do not have that layer of corporate risk. You own the asset directly. It is in your name. You are not relying on a bank manager to manage their risks properly. You are relying on the bedrock of the economy. In a world that is becoming increasingly fragile, removing the middleman is not just about earning more money. It is about eliminating a point of failure. Now that we have identified the right fuel, we must discuss how to stack it. You do not simply throw your entire wood pile onto the fire at once. If you do that, you will have a massive blaze for an hour, and then you will freeze for the rest of the night. You need a system that provides steady, consistent warmth. In the bond market, we call this strategy a ladder. The concept is elegant in its simplicity. Instead of buying one large treasury bill that matures in a year, you break your capital into smaller pieces. You buy bills with different maturity dates, stacking them one after another like the rungs of a ladder. Imagine you have a sum of cash you want to protect. You divide it into 4 equal parts. With the first part, you buy a 4-week bill. With the second, an 8-week bill, then a 12-week bill, and finally a 16-week bill. Here is the magic of this structure. Every 4 weeks, one of your bills matures. The government returns your principal plus the interest you earned. You now have a choice. If you need the money for an emergency, perhaps the roof has sprung a leak or you have lost your income, you simply keep the cash. It is there, liquid and ready. But if you do not need the money, you roll it over. You take that cash and buy a new 16-week bill at the top of the ladder. This creates a perpetual motion machine of income. Every single month, you have checks coming in. You are constantly refreshing your rate. If interest rates go up, you are happy because you are buying new bills at the higher rate. If interest rates go down, you are still safe because you have locked in your yields for the weeks ahead. This brings us to the most critical advantage of the ladder strategy during a recession. Liquidity is power. When the markets crash, as they did in 2008 or in the spring of 2020, opportunity is everywhere. Great companies go on sale. Real estate prices drop. The best assets in the world become cheap. But most people cannot buy them because their money is trapped. Their stocks are down 50%, so they cannot sell. Their real estate is illiquid. They are paralyzed. But if you are holding a ladder of treasury bills, you are in the strongest position possible. You have cash maturing every few weeks. You can step into the wreckage of the market and buy the highest quality assets for pennies on the dollar, simply because you kept your powder dry. History tells us this story over and over again. In 2008, while the S&P 500 was collapsing and banks were failing, short-term treasuries did exactly what they were supposed to do. They held their value. They paid their interest. Those who held them slept at night, and when the dust settled, they had the capital to build generational wealth from the ashes of the crisis. Building a ladder is not just about earning interest. It is about maintaining your agility. It is about ensuring that you are never forced to sell a good asset at a bad price just to survive. We have talked about numbers, rates, and ladders. But now, we must talk about the most important return on investment of all. It is not measured in percentages. It is measured in hours of deep, uninterrupted sleep. There is a concept I want you to consider: the sleep test. No matter how much money you make during a bull market, if you lay awake at night staring at the ceiling, wondering if your portfolio will survive the morning, you are not wealthy. You are a prisoner of your own assets. True wealth is the ability to close your eyes, knowing that no matter what happens in the world while you are unconscious, whether markets crash, banks stumble, or panic spreads, your foundation is solid. This is the hidden dividend of the Firewood Strategy. There is a quiet, powerful confidence that comes from holding the safest asset on earth. While your friends are checking their phones frantically at dinner, reacting to every piece of breaking news, you are present. You are calm. You are not worried about the Federal Reserve's next meeting because you know your ladder is already built. You have stripped away the noise. In Scandinavia, we often speak of lagom. It is a word that is hard to translate, but it means just the right amount. It is the perfect balance. It is not too little, and it is not too much. In investing, lagom is realizing that you do not need to beat the market every single year to win the game of life. You do not need to chase the highest, riskiest yield to prove you are smart. You only need enough safety to ensure you never get wiped out. This boring, predictable portfolio gives you that balance. It allows you to step back from the chaos. It gives you the mental space to focus on what actually matters: your health, your family, your skills, and your peace. Ultimately, the goal of this channel is not just to help you build a bigger bank account. It is to help you build a stronger mind. Financial safety creates mental toughness. When you are not desperate for money, you make better decisions. You negotiate better in your career. You take calculated risks in your business. You operate from a place of strength, not fear. A recession is a psychological game as much as it is a financial one. The investors who panic are the ones who are overextended. The investors who win are the ones who have prepared their minds by preparing their portfolios. By choosing the boring path, by choosing the dry wood, you are choosing to be the calmest person in the room when the storm hits. The winter may be long, but if you have followed the principles we discussed today, your woodpile is high. There is a profound sense of gratitude that comes when you realize you are no longer fighting the elements. You are not praying for the stock market to go up just so you can pay your bills. You are not dependent on the weather. You have built your own heat. This is the essence of the mindset for wealth. It is not about driving the fastest car or having the most expensive watch. It is about durability. It is about building a financial life that cannot be shaken by the wind. So, here's what I want you to do next. Take a look at your own portfolio today. Be honest with yourself. Do you see a stack of dry firewood ready to keep you warm? Or do you see a garden of summer flowers that are already starting to wilt in the cold? If you see flowers, do not panic. It is not too late to start gathering wood. Start small. Buy your first bill. Build your first rung of the ladder. Every step you take is a step away from anxiety and a step toward freedom. If you found value in this quiet approach to investing, and if you want to continue building your fortress with us, I invite you to subscribe to this channel. We do not chase hype here. We chase clarity. Thank you for spending your time with me. Stay warm, stay prepared, and I will see you in the next video.